Hello, chart watchers, and welcome to this Wednesday, May 16th Market Watchers live show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, let's take a look at the action so far today. We got the Dow Jones up 26 points. The S&P 500 is up 8. The NASDAQ doing a little better on a relative basis, up 36. And the Russell 2000 currently at a level that would represent an all-time high close. It is up 11 points today, clearly outperforming again today as it threatens a breakout. 10-year Treasury yield, again, up a couple basis points today. Actually, up less than 1 basis point. It was down a couple earlier. It has moved back closer to that break-even point. Volatility index came up to 15 yesterday, essentially testing the breakdown level. It has turned back down, is down 7% today, back down to 1360. Materials outperforming today, breaking above recent highs. Non-ferrous metals, the big reason why, as you can see, a nice move up to the upside. And within that group, Freeport-McMoRan making a really nice move to the upside. However, it is testing overhead price resistance from the breakdown that we saw from the late March low that was cleared just a few weeks ago. We are back up testing that level, so you want to watch that level closely on FCX. Utilities having a very rough day, as you might expect, with rates climbing. Nike making a breakout, though, above some very important resistance. This goes back over the last several months, just not these last two that you see here. This is a big breakout today on Nike. And GE, we've been talking about General Electric, the fact that it has been improving its chart. I really want to see it close with some increasing volume above 15. You can see the volume not that great today, but it is getting close to a key level. With that, let me bring in my co-host, Erin. Happy Wednesday, Erin. Not so happy for me in the caps, but hopefully you're having a better morning.
Yeah, I was very surprised that they didn't come through at home, but they've got some more time to go. I think they'll be doing good. I was just going to say I got a really good chuckle reading one of the survey responses. They say our show is absolutely awesome, which of course we love to hear, but they said it would be perfect if they could see us. And I don't know if it would be perfect.
It depends on what you call perfect.
Right?
That might
one day maybe.
That might detract from the show. My goodness. We do have a special guest with us, though, today. We got Dan Russo with us from Chaikin Analytics. Dan, how are you doing this morning?
I'm doing well, Tom. Thanks for having me.
Yeah, it's great having you back. I mean, we had you for a very brief period last week, just for, I don't know, maybe 10 minutes or so, talking about your new show and so forth. But you're going to stick around with us and give us a lot more information today. And you'll be back in about 15 minutes. So I just want to say it was great having you back, and good morning.
Thanks. I'm looking forward to it.
Awesome. Erin, we got a lot going on here, so I'm just going to turn it over to you for the announcements and the agenda, and we'll get this thing rolling.
Absolutely. So tomorrow we have Julius de Kempenaar. He'll be talking RRG, I am sure, since he developed it. On Friday, we have everything stock charts. I don't have a hint yet on what's going to happen then. And then next week on Monday and Tuesday, I will be out. I'm actually going to be in a cabin with no Wi-Fi, so I definitely can't do the show. So Julius has graciously accepted the challenge to be the co-host with Tom. And then we will have David Keller back on the show next Wednesday. So it's, every week is great. We have such a great amount of guests and such. Speaking of, as we were just discussing, Dan Russo from Chaikin Analytics will be here. And 10 and 10, we are going to start with Globus Medical, GMED. And that was an early email request to the market watchers at StockCharts.com. Sector rotation will be our final segment. And with that, Tom, I know we have a lot of technical headlines, a lot of people asking about the Russell 2000. I don't know if you're going to cover that, but there you go.
Yeah, well, I did kind of cover it already in the update. I mean, clearly the Russell 2000 is outperforming. I expect that. I expect it's going to continue at least in the foreseeable future because I expect the dollar is going to be rising. I'm going to talk about that in just a couple minutes. But first, while you're talking about headlines, this was a headline I wrote this morning for my blog, and I don't, really mean to dramatize everything, but to me, this was a very significant breakout in the 10-year Treasury yield yesterday, and my headline was the 4-decade-long downtrend in interest rates is over, and this is what it means. So I'm going to go through a couple of things that I think are really important as we go through 2018. Now, of course, technical analysis is only as good as the data that you're dealing with, and things can change. So the one thing, about fundamentalists is when they make a prediction, a lot of times they have to wait a period of time because it takes time for fundamentals to really change. Technicals can change on a dime. So I'm going to reserve the right to make a correction to anything that goes wrong. And I think that kind of fits with, what we talk about in keeping stops and so forth. You get into a stock believing that it's going to do something, but if it doesn't, you want to make sure that you have a secondary plan in place. I see a big breakout in the 10-year Treasury yield. This breakout here on this daily chart above the late April high that you can see above 3.03% is very meaningful in the short term. But what I'm most interested in is the longer term. And I'm going to switch over here to a monthly chart. And let's go back 50 years. I guess that's probably a pretty decent sample size. And when we look at a long-term chart on interest rates, there are two key lines that I've been following for quite some time. One is the trend line that we had established that goes down to, depends on how you draw your lines. If you use intra period lines, then maybe you're looking at about 3.30%. I tend to look at candle bodies. So I'm connecting the opens and closes as opposed to the intra period. And this is telling me that roughly there's a major trend line that dates back to the early 1980s. This is about 36, 37 years ago. So almost 4 decades. And this trend line has been in play for a long, long time. Now, I don't think we're going below zero in terms of interest rates. We have a double bottom that was in play here at the 1.40 area, something like that. So if you go down, connect those. And since then, or in between those two lows, we had a high that came up right here. We never had a close above 3.03%. Now, as you can see, where we are right now is a really critical juncture, in my view, from the long-term downtrend and also for this reaction high that we saw back in 2013 into early 2014. I think we're taking that out right now, which is really important. Now, could this on a monthly chart be a little bit of a head fake and we go back and close below 3% by the end of the month and it's just a test of the downtrend line? Yes, that is certainly possible. I do think that there are some subtle differences, though, than what we have seen in the past when we've had some of these moves. First of all, look at the monthly PPO. This is the longest period of strength that we have seen in a long time in interest rates. And again, it's coming off this double bottom. So I think there's a lot of force behind this move to the upside. The other thing you got to keep in mind is that the Fed is already talking about reducing its balance sheet. Its balance sheet is bloated from quantitative easing, the purchasing of Treasury securities, and they're going to be selling. And when they're selling, it tends to trigger others to sell as well. And when you're selling Treasuries, that sends the yield higher. Treasury prices go down, the yield goes up. There's always that 100% inverse correlation between the direction of Treasury prices and the direction of yields. So I think it's a perfect storm here. I think the U.S. economy is building. I think that is reflected in the U.S. rates versus foreign rates. The dollar is starting to move to the upside in a pretty big fashion. And I believe this is the start of a fairly significant breakout. Now, do I think rates are going to just go shooting up to 5, 6, 7%? No, I do not think that at all. I do think that this reverses the trend. I think we will slowly begin to move back up, possibly even come back down and test the support level, maybe even break below 3% for a brief period of time. But I think ultimately we're going to work our way back up, and maybe later this year and into 2019, I would not be surprised to see the new norm on the 10-year Treasury yield between 3 and 4%. So what do we do in an interest rate rising environment? I think that becomes really important. One of the things, and we've talked about this, I've talked about this a lot on the show. Here, this is what I was talking about in terms of the 10-year Treasury yield relative, in this case, to Germany. And look at what the yield has been doing. It has been rising, and it continues to rise. It is currently up near its high, near 2.5%, the difference between the two, which is the spread. And I've pointed this out multiple times, but I think it's definitely worth repeating. When we go through periods where the U.S. rates are rising faster than foreign countries, especially Germany, I tend to look at the U.S. market and the German market. There's a pretty strong correlation, positive correlation between the two countries. But when I look at these two and I see the U.S. rates going up and the dollar going down, or U.S. rates going up faster than Germany's, I should say, and the dollar going down, that tends to correct itself. Here you can see the temporary inverse correlations that developed during these periods when U.S. rates were rising faster than Germany, yet the dollar was going down. Both of the previous two occasions, we saw huge moves to the upside in the U.S. dollar. And when we first saw the move to the upside, I mean, when you look at this first move in the correlation back above zero, right to here, say, back in 2014, the dollar was just starting to make the breakout on what turned out to be a massive move. When you look back here in 2009 to this reversal off of an inverse correlation, as we're making this first push up into positive territory, the dollar is just starting to rise in what became a very significant move to the upside. I think the dollar is just starting to make this move. I think the dollar is going to make another huge push, eventually to test the late 2016 high, eventually maybe even break above it to follow what's been happening with the U.S. rates versus Germany. And when that happens, the small cap stocks tend to outperform in a very, very big way for a couple of reasons. Number one, the domestic economy is strengthening faster than foreign economies. I mean, that's one of the reasons why the U.S. rates are going to go up faster, or have been going up faster than other foreign countries like Germany. And when that's happening, when the strength is stronger in the U.S., that benefits companies that do most or all of their business in the U.S. So that's one reason why the Russell 2000 should outperform. The other one, though, is that when the dollar is rising, S&P 500 companies lose earnings because those foreign profits that they earn have to be translated back into U.S. dollars, and that translation rate with the dollar going up is going to cut into earnings. So those who are invested in S&P 500 stocks, seeing the dollar rising, will also move a portion of their portfolio into the more rapidly rising Russell 2000. I think we're already seeing that in terms of the Russell 2000. When we look at the S&P 500, for instance, and we pull up this chart, you can see this is where we sit right now in the S&P 2725. We are still 150 points below where we were at the January high. Take a look at the Russell 2000. The Russell 2000 today is currently making a breakout. This will be an all-time high, closing high, by the way. Look at where we were back at that January high. I think this rising dollar situation is already playing out. It's beginning to play out, and I think it's going to continue to play out. So the Russell 2000, I think, is certainly worth keeping an eye on, or even maybe overweighting based on some of the things that I've talked about. Now, some of the areas that don't do so well with a rising interest rate environment, we saw it yesterday when we got that breakout. I don't know if you saw home construction. Home construction got absolutely crushed to the downside. Now, I think rates are still fairly low. And so if the home construction stocks are dropping because of rising rates, I think that this is going to turn out to be an opportunity in home construction. And I'll pull up a longer term weekly chart, and you can see that we had a big move up. And I don't know if you read Arthur Hill's article over the weekend in Chart Watchers, but he wrote a really good article. It was something like a bird's eye view, long-term perspective, using a long-term perspective. And essentially his article was saying that when you have a big advance in the market, or in anything really, you deserve a bigger decline, a bigger, maybe scarier consolidation period. The home builders, home construction, made a huge move from 500 to 1,000. It doubled in roughly 15 months. They deserve a bigger correction than other areas of the market, and they are certainly getting that. I don't think that this run to the upside in home construction is over, because I think that the economic strength will be such that rates, a little bit higher rates are not going to, I don't believe, slow the economy. So what I'm looking at is perhaps a move back down to test the 725, 730 area on home construction. I think that would set up a really solid entry point into this group. But I want to see some things develop. As I mentioned, I think I mentioned in my blog, I'm not a fan of home construction. I don't own any at this point. I wouldn't buy any right now, but I'm not giving up on home construction. I think that we will eventually have quite an opportunity here as we look further down the road. Now, before the show started, I was actually talking to Dan Russo, and I'm sure he may mention some of this in a bit when he talks. But he brought up a great point about the home construction group that I had not looked at. And Dan was talking about lumber prices and the fact that the lumber prices have been shooting through the roof, no pun intended. But here we got a huge move up in lumber prices the last couple of months. So you've got a couple things working against the home construction group as a whole. We've got much higher lumber costs, which are difficult to pass along to your customers. And then you've got higher interest rates, making it more difficult for your buyers to borrow. So there are really two things that are factoring against the home construction group. And I think that's why we're getting hit so hard right now. But I'm going to bring up another chart, which I think you'll find very interesting. And, I love this correlation feature that we have here at StockCharts. And so that's lumber prices. Now, let's take a long-term view on how lumber prices tend to stack up. Again, no pun intended. Versus the home construction group as we look down the road. Now I'm going to go back and let's look at, we'll just do 10 years and a weekly chart and see how this develops here. So here are your lumber prices. And then here is your correlation. Now you can see there's a little bit of back and forth. But what I find interesting is that most of the time is actually spent in positive territory, meaning that lumber prices and home construction stocks tend to go in the same direction. But one of the things I'm looking at here is we're at one of the lowest inverse points in terms of correlation between lumber prices and home construction that we've seen in the last 10 years. So I believe one of two things is going to happen. Either these lumber prices have completely gotten out of whack and we're going to see lumber prices coming back down, or I believe that this is a sign of strengthening demand in improving economy, which in time will mean home construction stocks rebound and start to join the move to the upside, and we move back into positive territory here. Very similar to what I was looking at on the correlation with the movement in the dollar and the movement in U.S. rates versus Germany, and the small caps relative to the S&P. When we get that negative correlation, all of a sudden you get this snapback move in one direction. I think it could be with the home builders down the road. But again, I would wait just a little bit before getting too excited about that. There was one other correlation chart that I wanted to show you. And that is with rising rates, some of the things to look at, to keep in mind as we go forward. That wasn't what I wanted. As the Treasury yields rise, if I'm correct, and that we are starting to move higher, there are some other correlations to keep in mind. First of all, when the 10-year Treasury yield is moving in one direction, utilities relative to the S&P tend to head in the other direction. So as interest rates are rising, that puts a lot of selling pressure on utility stocks, and they tend to underperform. So this whole thing right here, going back the last 10 years, you can see that the relationship, the correlation between the 10-year Treasury yield and the relative performance of utilities is inverse. But notice what just recently happened. We actually have a little bit of positive correlation. And that tells me that we're probably going to move back down into the norm, into negative. So what's going to happen? Is the 10-year Treasury yield going to come down? Or is the XLU relative to the S&P 500 going to falter? I think we're going to see utilities underperform going forward. I think this is going to come back. I would not be in utilities right now with the 10-year Treasury yield breaking out. The next is real estate, the Dow Jones REIT Index, DJR. I did the same thing here, looking at the 10-year Treasury yield and correlating it versus the REITs versus the S&P. And check this out, mostly negative, but rising and getting close to a key area near that center line. The next two are areas of the market that tend to go in the same direction as the 10-year Treasury yield. So if we believe the 10-year Treasury yield is going up, you want to look at banks. Banks versus the S&P 500 tend to be very strong. That correlation between the rising 10-year Treasury yield and the outperformance of banks, you can see that's very strong. Or the declining 10-year Treasury yield and the underperformance of banks. They tend to correlate very strongly, positively with one another. Same goes for insurance stocks, the DJUSIL, where we tend to be positive. But look at what's been happening recently, underperformance in these areas. So I think what we're going to start to see is major underperformance in the REITs, major underperformance in the utilities, and a return to the norm in both banks and insurance companies. I expect these two correlation lines to turn higher, perhaps in a big way. And with that, I'm going to bring in our special guest today. He's Dan Russo. He is the Chief Market Strategist with Chaikin Analytics. Dan, welcome back to the show.
Tom, thanks. It's good to be back.
Yeah, it's good to have you.
I feel like you kind of went through everything I wanted to touch on today, and I can leave now.
No. We want your perspective. Trust me, you've been doing this a long time. And I know everybody, enjoyed your presentation when we had you on last week, but you were only
great
for a couple minutes. So I'm going to let you take it away.
Excellent. Well, thank you so much for having me. Can you see my screen or?
Yes. Yep. We're good.
Okay. So as Tom mentioned, I host a daily show here at 9:15 every morning. It's PowerFeed TV, brought to you by Chaikin Analytics. As Tom said, I'm the Chief Market Strategist at Chaikin Analytics.
Sorry. I think it was, you do need to share your screen. I saw,
okay, no worries.
Yeah, I saw a slide up, but it wasn't yours.
How's that?
Now you got it. Go ahead.
Perfect. All right. So every morning, 9:15, Chaikin PowerFeed TV. PowerFeed is kind of a free product that we supply. You can go to chaikinanalytics.com/PowerFeed TV to get it. It's just kind of a quick snapshot of what's going on in the market, kind of high level, what you need to know. Our firm, Chaikin Analytics, supplies most of the data. I supply some of the data as well. And again, I'm the Chief Market Strategist over there at Chaikin Analytics. I'm also a chartered market technician. So I definitely come to the market from more of a technical background. And it's good to be here. I put together kind of some high-level thoughts, but just to kind of go through what PowerFeed can do. We kind of give you the quick bullets of what you need. This is actually from this morning, and I publish a daily note, and every Wednesday it's kind of thematic. I look at sentiment, so that's why that bullet point is there. And I always kind of look at a sector. Tom, you were talking a little bit about real estate, and I think I have a chart that's similar, but I'm really bearish on real estate for a lot of the same reasons that you were talking about, in particular the higher rates. Kind of quick, you can get a high-level snapshot of what's going on with the major indices. We have something called the Power Gauge, where we rank all U.S. listed stocks and ADRs from either very bullish to very bearish. And then what we can do is take an index or an ETF and kind of sum up via our power bars how many stocks are either very bullish or bullish, how many are neutral, and how many are very bearish or bearish, to kind of give you a high-level view on an index or a sector. I know, Tom, you said you guys are going to be doing some work on sector rotation later. I can show you how we kind of look at that, and I do have a slide for that. But you can see the Dow is skewed slightly negatively. The S&P 500 is skewed a little bit more negatively. The NASDAQ is pretty flat, 14 bulls to 15 bears. But here's what you were talking about, right? Small cap outperformance. Look at how we rank the small cap stocks. 464 either bullish or very bullish stocks, and only 334 bearish or very bearish stocks. So you can see where that outperformance is coming from. It's there at the stock level. So it's not, one major component of the small cap index or a handful of major components, kind of like what the FANG did for the S&P 500 last year, pulling small caps higher. Like you could see, breadth is squarely positive for small caps. And then obviously yesterday, the 10-year yield closed at its highest level since, I think, mid-2011. So bonds were hit pretty hard yesterday, driving those yields higher. I have a view on yields. I think they are going to go higher. However, I do not think that that's super bearish for the equity market overall at this time. We can touch on that a little bit later. PowerFeed also gives you, here's those sectors, the major sectors and how they've moved over the last 5 days. No surprise to see energy at the top of the list, given the move in oil, kind of really sustaining the run over $70. Financials, as you said, you alluded to, financials are a product of rising rates, so not a surprise to see those guys towards the top of the list. And then the bond proxies are obviously lower. Utilities over the past 5 days down 36 basis points, and real estate down over 1%. Every day we pick an industry in focus. It could be a bullish industry. It could be a bearish industry. Again, driven by those power bars. And, software and services has been a great performer of late. in a strong sector, the technology sector. You can see here we're more than 3-to-1 bullish to bearish on our power bars. This stat amazed me though, that this group is outperforming the S&P 500 by over 9% over the past 6 months. I mean, I'm a momentum and a trend following guy. When I see something like that, I kind of want to look at every software and service stock in sight and find the ones that are most compelling and kind of load the portfolio with those. And you can see, obviously, the power bars measure future potential performance, and they are very strong. It's a top third ranked subsector of the 21 that we look at, although it has kind of moved down of late. Fine, it's had a big run. But, some of the stocks that are in this group that are worth looking at on the long side, and they all have very bullish ratings based on our 20-factor model at Chaikin Analytics. So, a name like CoreLogics or CACI or Verint, these are indicative names of the strength that we're seeing in this group. And these are names that, maybe you want to do more work on. And, if they're not set up perfectly right now, maybe they've run a little too far, too fast, to at least have on a watch list. And, I kind of wanted to break down how we look at the world and use one of these stocks as an example. So, as I said, those power bars are driven by the power gauge rating, and for CACI, it's very bullish. And this is as of last night's close, so the stock was down 46 basis points yesterday, but you can see it outperformed. I mean, the S&P 500 was down 80 basis points, and the Nasdaq was down over 1%. So even in a down tape, CACI was down a lot less than the broader indexes. The trends are strong, and the industry is strong. So we kind of know we're fishing in the right pond, right? We have a very bullish stock with a strong trend in a strong industry. We take a top-down view, right? What's the market doing? What are the strongest sectors in the market? What are the strongest industries within those sectors? Now let's go find the best stocks, and those are your long ideas, right? So from there, we look at the charts from the bottom up. This ribbon here tells us where the power gauge has been over the past 12 months, and you can see, a year ago it was mostly neutral with some spurts of bullishness, and you can see how that flipped. Starting at the beginning of the year, the power gauge for CACI has flipped, and it's mostly bullish with this one kind of spurt of neutral activity. But for us, the key is, once we know we have the rating, we want to know how the stock is performing relative to the market, what we call kind of our dynamic duo. We want to see the market agree with our model, and that's exactly what you have going on here right now with CACI. It's outperforming the SPY. It has a very bullish power gauge rating. So, we know this is a stock we want to at least be looking at on the long side, but, tactically is now the right time to buy the stock. And I would say you should probably wait, right? You have this breakout above the $160 level that registered an overbought condition. This is a proprietary indicator built by Mark Chaikin. I mean, I get to work for somebody who's been doing this for a long time. I mean, Mark has built indicators that are still widely used today by traders all over the street. So it's a great learning environment for me. And you can see this is one of the indicators that he's built. The stock is oversold. So we want to maybe wait a little bit for a consolidation. But what else is interesting too, this is another, Mark Chaikin built the Chaikin money flow indicator, and it's a sign of institutional buying and selling. And you can see a year ago, this stock was mostly under distribution. Institutions were selling the stock. And then somewhere around the fall, they started buying it. And, it's been consistently accumulated by institutional investors ever since. So that's encouraging. So CACI is a name that I now have on a bullish watch list. Maybe we get a pullback to, the $158, $160 level. Let this indicator work off this overbought condition and set up a tactical entry point on the long side. So that's just kind of some of how we look at the world. Here's what I was talking about from a sector rotation standpoint. These are those power bars on the major sector ETFs, and you can see financials as of last night was the strongest group. Energy, no surprise. Healthcare and technology. Those are the four groups that have bullish skew to their power bar ratings, and along with materials are outperforming the SPY. So like when you're looking at sector rotation, this is just another way that we look at it. We want to know, it's more of a bottoms up approach on this aspect. It's like, what are the individual stocks doing, and how does that drive the sector? So, you can see financials are skewed 2-to-1 to the bullish side. Energy more than 2-to-1 to the bullish side. Healthcare a little bit less than 2-to-1 to the bullish side. Technology kind of down ticking here a little bit, but still bullish. And here are those bond proxies. the ones you were talking about, utilities, you were talking about real estate. I mean, there's only one way to describe this, and it's, disaster. One bullish or very bullish stock for 15 bearish or very bearish stocks in the utilities, and real estate, one bullish stock for 23 bearish stocks. So, you want to kind of be looking for long ideas in the groups that have a bullish skew that are leading the S&P. And these are your short ideas down here. Utilities, real estate, consumer staples. I mean, these three sectors you want to avoid. And if you are inclined to short stocks, those are where you want to go kind of hunting for short ideas. We can see, the slightly negative skew to the SPY, and it's really been that way since the market started consolidating. So that's some of the proprietary IP that we have at Chaikin Analytics. My view on the market, the S&P 500 is consolidating within a secular uptrend. This is a 2-year chart. I mean, you can see that on a closing basis, once we closed below the 200-day moving average. I kind of view this as a consolidation within the secular uptrend. I do expect it to resolve to the upside. I mean, if you wanted to draw a trend line off the January highs here, we have broken through, and maybe we come back to retest. One of my concerns has just kind of been momentum. This is a 14-period RSI. The fact that momentum on rallies has not been able to get overbought during this consolidation, I actually want to see this metric become overbought. It is encouraging that we do have a series of higher lows of late, but I do want to see this metric get overbought on a move higher by the index. That would give me a lot of conviction that the secular uptrend is in fact resuming. But right now we're still in a consolidation. There's opportunities on the long side in the strong sectors. There's opportunities on the short side in the weak sectors. So kind of looking, this is the past 100 days for the S&P 500. You can see the key support and resistance levels. Here's 2741. We hit our head on that on Monday and we retreated. I mean, this is as of last night's close. We are kind of flat to up small today. I look for support in the 2658 to 26.5 level. That was former resistance, and then obviously the 200-day moving average. If you're bullish, you want to see a break above 2741, give you conviction that the uptrend is resuming. That is the camp I'm leaning, but as always, we kind of let price dictate. If you're bearish, you want to see a cut below the 200-day moving average and then an undercut of the February lows. That would give you a clue that the uptrend is kind of over and it was potentially reversing. From a sentiment standpoint, and this is something that gives me conviction that we are going to resolve higher, is that there's contrarian firepower out there. This is something that I built. It's a 13-period moving average of the CBOE put-call ratio. The ratio itself is very, very noisy, so I took a 13-period moving average to kind of dampen the noisiness, kind of smooth it out. And what's interesting here is we're still elevated relative to where we were through all of last year. And I look back at the stats and, when this metric is over 0.9, the market is higher 6 months later, like 70% of the time. So, this leads me to believe that we're going to resolve higher because sentiment hasn't gotten overly bullish yet. It did get overly bearish back when we made a low late March, early April. Readings over 1.1% are generally signs of capitulation. So we did see a capitulation low about a month and a half ago, but we are still elevated. So I do think that there's some contrarian firepower out there to take the market higher. Breadth. Something else that I'm looking at here, I look at a lot of breadth indicators, but I think this one does the best job of illustrating why we could resolve higher. This is the S&P 500 advanced decline line. We made a new high last week. So it's, stocks are moving up. Some of the bigger names might be holding the index back for now, but I do think ultimately we're going to resolve to the upside because we have that contrarian firepower from, the put call ratio and sentiment. We have breadth kind of moving to new highs. So I do think that the firepower is there to take the market higher. You mentioned small caps breaking out. This is a relative chart. This is the Russell 2000 relative to the S&P 500. And you can see that we've broken a downtrend line. This is a 200-day moving average of that relationship. We are above that. I do think we're going to continue to move higher. I think the key drivers there, number one, dollar strength. Number two, now that we've kind of wrapped up earnings season, trade war headlines, trade tensions, whatever you want to call them, are going to come from the back burner to the front burner. And I think that as long as trade tensions are a concern to investors, to your point, Tom, small cap stocks get more of their revenue here than they do overseas. Relative to large cap stocks, I think small cap outperformance is something that's going to continue to play out. And we're seeing it again in those power bars that I showed you. The small caps were the only one that had a bullish skew to their power bars. And here's that same 14-period RSI, just applied it to the ratio. It's made the shift into bullish ranges. I think that this is a trend that's going to continue, small cap outperformance of large cap. Here is that dollar index. Look at the downtrend that we've broken and kind of moved through the 200-day moving average in a move that was confirmed by momentum. Maybe we are a little bit overbought here. Maybe we see a little stabilization or a consolidation, but I think that this is a trend that has reversed itself as our rates move higher, especially relative to the rest of the world, because the rates trade really is a relative value trade. Even at 3%, we're massively above what the rates are in Europe and in other parts of the world. So on a relative basis, I think you're going to continue to see money flow to the U.S., and that's going to help the dollar. Here's commodities, and this is an interesting conundrum, actually, that as the dollar is rising, commodities are breaking out of this kind of 2-year base that we've been in. This is a 5-year chart. You can see the massive downtrend. We reversed, and we've been basing for 2 years. And we're starting to come out of that base. We're above the 50-day moving average. We're above the 200-day moving average. You don't usually see commodity strength with dollar strength, but you're seeing it here. Now, granted, oil is a large weight in this index, so we'll watch to see how that plays out. But as oil moves, but you showed that chart of lumber. I mean, commodities as a whole are moving higher, with the exception of gold recently. But I think that this might be a premature breakout for commodities as an asset class, just given the strength that we're seeing in the dollar. But right now it's working. We'll wait to see how that plays out. Here's the 10-year yield. This is a 5-year chart. You can see the breakout. I mean, you had that long-term chart, Tom. That was unbelievable. 40-year downtrend being broken. This is more near term, but you can see, I'm not a huge pattern person, but if you wanted to, you can call this a head and shoulders, breakout. My call actually was above 2.6%. 2.6% was the key breakout level for me. I said at the time I was on an institutional sales desk, and I wrote in a note to institutional clients that as long as we're above 2.6%, I think the path of least resistance is higher, with room to 3.2%. We are above that level, and now we're breaking through the late 2013 to early 2014 highs. I still contend that the path of least resistance for 10-year yield is higher. However, I do not think that that's a negative for the equity market as a whole. It is a negative for the bond proxies, but I looked back at data going back to 1963 and basically did a quick study of when the 10-year is higher than it was a year earlier, but still less than 5%, which it is now. What does that mean for the market? And, incidentally, the market is in that environment going on data going back to 1963. The market's positive a year later, 89% of the time, for a median return of over 10%, over 10.5% actually. So when you read in the headlines that the market was weak yesterday because bond yields were moving higher, it's nonsense. You need to ignore them. I've done the work, and it's just until we get to about 5%, rising rates are not a negative for the equity market in general. They are a negative for real estate, though. Here's the XLRE, kind of on a Chaikin chart. You can see it's been underperforming the market for most of the last 12 months. Money flow has been predominantly bearish since December. And, the XLRE tried to rally here, but now it's kind of met resistance and is rolling back over. We have some proprietary signals that we use. This one was a relative strength breakdown yesterday. I expect real estate to continue to roll over. I look for short ideas there. AIV is a name that comes to mind. And here's what I was talking about. Here's the chart that you showed, the 10-year yield working higher, the real estate index working lower. The correlation is generally negative, but it has kind of picked its head up here. And when that's happened in the past, when the correlation's gone positive, it's been the real estate group that's traded off. It happened here in early 2017, happened again late 2017. You got a pop higher in the correlation, and then the real estate stocks are what sold off. That is my view here now. My thesis is that real estate names are going to continue to move lower as rates move higher. So you mentioned GE, so I threw this. I had a little bit of time to throw it into the deck. GE had a neutral or neutral negative rating for 2 years as it continued to work lower. It was a massive underperformer relative to the SPY. You can see this downtrend. Mark Chaikin likes to say that bottom fishing is the most expensive sport in America, and you can see why. I mean, just a straight down, textbook downtrend. But what's funny is that at the end of April, mid to late April, our model actually turned positive, turned bullish on GE. It's above our long-term trend line. Money flow is not there yet. The believers aren't there on the institutional side, but this is actually a name that I'm keeping an eye on. If I can see this stock begin to outperform relative to the market and see some institutional sponsorship, I think it's going to be a compelling name on the long side. And just wanted to point out that our model flipped bullish on GE back in mid to late April. So for anyone who's interested, you can get PowerFeed, but I'd like to open it up for questions and kind of go from there. Tom, Erin, anything you think is interesting?
Yeah, no, we are going to get the poll up because that was one interesting point that I wanted to talk about in terms of just where the audience sees maybe Treasury yields going. I believe we're going higher. I don't think we're just going to go, screeching higher up to, 5-6%. I don't see anything like that, but I do think that the norm now, where we've been in the 1.5 to 2.5% range for a long time, I think this breakout, I kind of agree with you, 2.60 breakout was important. I really think this 3.03, 3.05% break is very significant on a long-term chart. And so I'm thinking, maybe 3 to 4%. I guess first, do you have any thoughts as to where Treasury yields might be going later in 2018 and into 2019, or just the fact that they're going up?
Yeah, I mean, look, I think going up is first and foremost. I think a near-term target is kind of 3.2%. I think that I agree with you. I think it's going to be a gradual rise. I mean, we talk about the rising rates are not bearish for the market overall. I gave you that stat about when rates are rising, but still under 5%. But, if we woke up one day and 10-year yield was at 4%, the equity market's going to get hit that day. What the market needs is time to digest the move higher. And if you saw, it was really the kind of the violent move higher in yields back in late January when inflation fears became a concern that hit the market. It's more the pace of the move than the actual move itself and where it goes that I'm kind of watching for. My view is 3.2% now, and then we kind of take a breather.
Yeah, and I saw, when you talked earlier about the 10-year Treasury yield and the fact that when it goes up, when it's up, I forget the numbers you said, but as long as it remains below 5%, when it rises,
the market is positive a year later, 89% of the time.
Yeah, and it makes sense. And, I've done studies with the correlation on the 10-year Treasury yield and what happens with the S&P 500. And from a short to intermediate term perspective, there's a very high positive correlation between the direction of Treasury yields and the direction of the S&P 500. And if you think about it, if Treasury yields are moving up, money is rotating out of bonds. It's moving out of the Treasury market. That money's got to go somewhere. And usually the reason for moving out of bonds is the same reason why you would move into stocks. So it makes sense that that money would rotate. Now, at some point, rates will go too far. I don't know when that is. My guess is, we're probably okay to 4 to 5% would be my guess. But that could trigger a recession somewhere down the road. I think it's way too early to think about that. And you can see from the poll here, do you believe that the multi-decade decline in Treasury yields has ended? We have almost 200 responses. 3/4 are saying yes, that they believe this Treasury yield decline is ended. That's 35, 36 years worth of a downtrend, maybe 37. That's a pretty significant downtrend. And if it does break, in my opinion, it changes a lot of the big picture investment ideas. And you touched on some of those during your presentation. And Erin, I don't know if we have some other questions, but would love to hear from you.
Oh yeah, we have some questions for
sure.
I
was kind of worried when I find myself in the consensus, but right now the consensus is the place to be for yields. I mean, one of the things that I do look at, we didn't touch on it today, is kind of the commitment of traders data and I kind of look for when these trades become really crowded. I will say that the short bond trade is somewhat crowded right now, which kind of gets to your point of we're probably not going up in a straight line, right? Look at the consensus here, 75%. 75% of our respondents here think the multi-decade decline in Treasury yields has ended. I'm going to tell you that positioning is mostly short amongst speculators. So, that's why I said I think we could get to 3.2% and then kind of stall out there. I don't see us going there going to 4% in a straight line, just because short bonds is a crowded trade.
Mm-hmm. Well, we saw that too from December to February. We saw a big move up in the 10-year Treasury yield from about 2.35% to 2.90, and then we drifted lower for the next 2 months. So there's nothing that we don't go up to 310, 320, and then drift for a couple months, maybe even go back down below that 3% level. But Erin, did you have some question?
Yes. So actually in this discussion about interest rates, the person said, historically 5% is an inflection, but the question is, does the size of our national debt and QE unwinding, would that change your position on this?
I mean, I'm not an economist, so if we're going to talk about national debt, that's kind of above my pay grade, if you will. Mm-hmm. Obviously, I think all of that data gets factored into the bond yield, right? If you like people like to say, a stock price reflects all the fundamental data, right? That's known at the time. If you believe that the market is relatively efficient, right? It's not 100% efficient. Otherwise, what would we be doing here? I think the same can be said for Treasury yields. I mean, the Treasury yield going higher, to me, reflects the rising national debt. Like where national debt is going based on policy. Like, I'm not a policy person. I'm not an economist. I'm not a beltway, a beltway watcher. And there are people on Wall Street who do that, and it is important. But it's not what I do. So I can't really comment on it other than rates are going higher. My guess is fixed income investors are incorporating some of that into their thoughts and in their analysis, and it's being reflected in rates. I mean, the Fed has told you that rates are going higher, and as long as the data supports it, and the data so far has supported it. I mean, the debate is whether or not we're going to have 3 rate increases this year or 4, right? So the Fed has told you that rates are going higher, right? The market is telling you that rates are going higher. So, like I said, I'm a kind of a trend follower. I think rates are going higher. Do I think they're going there in a straight line? No, but right. I agree with Tom's view that, this multi-decade decline could be ending.
Right. And I tend to be of the mindset that a lot of this stuff is baked in, to what's happening, but I'm kind of a purist as far as technical analysis goes. But I'm always explaining that to people. Well, what about this going to happen? What about this is going to happen? I'm like, you know what? It gets baked into the price as you go along, because you're thinking the same way investors are thinking. You're thinking about these things, and so they're going to react in a certain way, and that gets baked into the prices.
Right. It's like, the market is for the most part efficient.
Right.
But it's inefficient enough that it makes it worth our while to be sitting here having these conversations and trying to figure out ways for us to take money out of the market, right? Mm-hmm. But for the most part, there's a lot of smart people analyzing this constantly. You can assume for the most part, to your point, it's baked in.
Right. All right. A couple more questions. A quick one. What's going to be the difference between the 9:15 show that you do here on StockCharts TV versus what you get in the PowerFeed email?
There's not going to be a ton of difference. Everything that you see on the show, you'll get in the PowerFeed email. It's just kind of going to be me providing some color around it, right? Mm-hmm. Why certain, you're going to get that email, and it's going to show you that small caps are outperforming large caps based on our proprietary power bars. But I'm going to be on to kind of tell you, at least give you my 2 cents as to why I think that is, right? Why I think it's a function of a rising dollar, as well as, trade concerns, or, why bonds are down. It's going to be my commentary over what's in the email, as opposed to just getting an email and saying, well, maybe you think to yourself, right, oh, I wonder why small caps are outperforming. I'm going to tell you why I think they are. Am I going to be right 100% of the time? Absolutely not. But at least it's some color and not just, it's context to the data points.
Excellent. And then just sort of a general question, what indicator, you have so many different indicators that you and Mark Chaikin use. Which one do you give the heaviest weight? And, would that be the Chaikin money flow? And if so, how do you use that as far as your heaviest weighted indicator?
Well, first and foremost, the ranking, the power gauge rating. So the power gauge rating is basically derived from a 20-factor model that Mark Chaikin built, right? And you can almost think of the power gauge rating, and interestingly, Mark's best known as a technician, but the model is only 15% technicals. So there's a ton of fundamental data in there: financial data, earnings data, analyst, earnings revisions and earnings trend, right? So it's 85% fundamental, which is people always are surprised by because Mark's best known as a technician. But there's the belief that fundamentals over time do drive stock prices, and the way I kind of look at it is the power gauge is the most important because it tells you what to buy, right? You want to buy stocks that have a bullish rating or a very bullish rating. From there, we want to buy the bullish stocks that are outperforming the market, right? Mark will tell you that relative strength acts alone as an indicator. So you saw that chart that I put up of GE, right? GE had a neutral rating in our model for 2 years, but you didn't want to touch it because it was underperforming the market for 2 years, right? So the market is going to win out, right? Which is why we say we want to see the two in gear. I want to see a bullish stock that's outperforming the market. That gives me a ton of conviction. So I would say relative strength to the SPY and the power gauge itself are the two most important variables that I look at. From there, the overbought, oversold, and the Chaikin money flow, those are tactical, right? Once I know what I want to buy, once I know I'm as I like to say, I'm fishing in the right pond, right? I have a bullish stock or a very bullish stock and it's outperforming the market. Those other indicators are more tactical. They tell me when I want to buy them, right? I want to buy a bullish stock when it's oversold, right? And that's a very short-term oscillator that Mark built. It's designed to become oversold even in a sideways market. There are people out there who aren't trend followers. There are people out there who stare at a screen all day and will trade and try to scalp 50 cents or $1 out of a stock. You could do that with this indicator because it's extremely sensitive. So me personally, I want to buy the stocks that are going up when they become oversold. I'm not looking to scalp 50 cents, but everybody has their own style. So the main indicators are relative strength and the power gauge. The others are kind of give you a tactical based on your trading style, when to buy and when to sell.
All right. I think that was a great answer. And that pretty much covered it. There were a few specifics, but I will send those to you. And
sure, that'd be great.
Ask them maybe or answer them later in your show or blog.
Hey, Dan.
Yes.
One question before you go, and I was looking at a couple of the stocks. I agree that the software group has been a really strong group, and one of the stocks I think that you had mentioned was CACI.
Yeah.
Been performing excellent. Question for you. Currently, today, that stock is traded 22,000 shares, and I'm more, I like to follow volume. I don't like to trade stocks that don't typically trade a lot of volume. Is that a consideration at all in what you all look at? Do you look at the volume levels, and would it concern you that a stock like CACI only trading 22,000 shares, that maybe it doesn't have the liquidity that you would want?
Listen, price and volume. Like I said, there is a technical component to the power gauge rating where price and volume are taken into consideration. Yes, and it depends on your size, right? Liquidity is always a concern, but it's situational to your position sizing, right? If you're looking to buy 100 shares of this just to have exposure, then the 22,000 shares that traded today can absorb your order no problem. But if you're an institutional investor and you want to make this a 2% position in your $500 million portfolio, that obviously comes into play, and how you execute your orders become a factor. But price and volume characteristics are built into the power gauge model.
Okay, awesome. Now, did you say that at one point you were on a trading desk?
I spent 10 years on an institutional sales and trading desk. I covered hedge funds, mutual funds, and pension funds all around the country.
Okay, I don't know if this is something that you would be interested in discussing. I know, I talk a lot about market makers and those, middlemen that have to kind of, they take institutional orders. But
before that, I was a market maker at the New York Stock Exchange.
All right, well, you're going to be perfect then, because I would like to have a discussion. Maybe we can have a 30-minute discussion one day on here about the role of market makers, because I really don't know that the majority, and I would say probably even probably a minority of the folks listening in right now have a whole lot of knowledge about the market maker role.
Sure.
In short term, because you were talking about efficiencies in the market. And I think the market short term is very inefficient because of the market makers and, how they are building inventories, getting out of inventories and so forth. And I would love to have a discussion with you on that one day, if you don't mind.
Yeah, I'd be happy to. I mean, look, I know it's changed. I mean, I left the New York Stock Exchange. When I was there, we were known as specialists,
right?
Not even market makers. So I left the New York Stock Exchange at the end of 2007 and transitioned to a sales and trading desk where there were still market makers. The role has changed tremendously in that kind of 10 and a half, 11 years that I've left. But yeah, I'd be happy to have a conversation from, kind of my view on things.
Okay. Excellent. That would be awesome. We'd love to have that. And I think it would be a really interesting show.
Well, I know we're going to try and get you back here once a month is what I heard rumor of. So maybe you can write.
Yeah, that would be great. I'd love to do it.
Yeah. Next time you're here, that would be a great discussion.
Perfect.
Awesome. Well, it's always a pleasure to have you on the show, Dan. Looking forward to having you back. And everybody out there should check out Dan's show in the morning. It is before the market opens. Just a quick little, nugget of information could help in your trading. Absolutely. So again, thanks for stopping by, Dan.
Yeah. And if you have the PowerFeed email, the PowerFeed email goes out before the show is broadcast. So you can kind of have a chance to look at it and get a sense for what we're talking about. I think that's helpful as well.
Awesome.
Excellent.
Appreciate it. All right.
Tom, Erin, thank you so much for having me.
Oh, absolutely. Anytime.
Yep. Thanks for stopping by.
Thank you.
Mm-hmm.
All right. And there he goes. That was a really interesting discussion. And yeah, I kind of, he and I think, kind of look at the market very similarly, obviously, as we went through a number of the areas of the market. And sometimes that's a good thing. Sometimes it's not such a good thing. Always good to have a little bit of back and forth and maybe something that is, can be debated a little bit. And I think as far as how far the rates go, I agree with Dan. I think that at this point, the charts are telling us that we've got the breakout. So it's really not a debate on whether we are breaking out, because we did. We broke out yesterday. It was the highest close on the 10-year Treasury yield in the last 7 years. So it's not really up for debate. The question, I guess, really is where we go from here and how we get there. And so it'll be interesting to see how all of it unfolds. But I know we got 10 and 10 and we got a ton to go through. I'm going to try and go through it lightning fast today.
All right. Yeah, we do have a lot. We have 44 symbol requests today. That's very unusual. Usually it's around 30. So a lot of you will be disappointed, but we'll do our best. Go ahead and in the chat room, which is to the right of your video player, if you're watching on the StockCharts TV tab on StockCharts.com, go ahead and like your favorite symbol requests that people have put out there. It's too late to add them at this point. And as you can see, tons of them. I'll give you just a really quick RRG. I know our first one is going to be GMed. So I know you probably already looked at that one and are probably ready to go.
I am. Are you ready for me to take the screen?
Yeah, absolutely. Just as you can see here, we've got, actually, there's a lot of them sitting in that lagging category. So I think that's pretty interesting. I'll have to see if we have any moving in the right direction from that area, among others that look interesting here too.
Okay, well, let me go ahead and pull this one up. This is GMed. First of all, it is about a $5 billion healthcare company, and that has been the sweet spot in the stock market for a while. Those small healthcare stocks, solid move to the upside, solid consolidation. I think the stock eventually makes the breakout. Now, you might look and say, well, look at all the selling that's taken place. Well, it's taken place, but holding on to key support areas. So I'm not overly concerned about that. I'm more interested in the fact that we're sideways consolidating after an uptrend. I see a breakout coming. I am bullish GMID.
All right. And, I know we touched on GE earlier, and I know Dan talked about it, but would you be willing to take that up? That is the most popular request is GE. Get your targets, stops, etc. on that.
Yeah, I think it's a very, I agree. I think it's a bullish chart. We've been talking about this one. I think the fact that we were able to get back up and test this gap resistance area on heavy volume back in April, that was really something that GE hadn't been able to do for quite some time. We just kept trending lower and lower and lower. And I get a question a lot. I've gotten it in the survey responses, that I kind of missed the boat because I didn't short or talk about shorting GE. Well, I still believe we're in a bull market. I don't short during bull markets. So this is something that I would not consider. We have talked on many occasions about how bearish we've been about GE, but shorting it is just not something I do during a bull market. But I do think that with the move up, the pullback, the holding of these moving averages, and now the 20 crossing above the 50, PPO looks good. I think this is as good as GE has looked in a long time. And it kind of reminds me of that movie, As Good as It Gets. Is it as good as it gets? I think, well, it depends. If we get this breakout above 1510 and we do it with some increasing volume, I'm not sure that it's as good as it gets. I think GE could be bottoming here. So I'm holding out some bullish hopes for GE, but I want to see a little bit more. I want to see that breakout above 1510, and I'd really like to see volume come in and show that institutional support that Dan was referring to earlier.
All right. The next one I have for you was also quite a popular request, Disney, DIS.
Yeah, Disney, I looked at earlier before I did the update. I didn't put it in the market update at the beginning, but it is showing some very bullish tendencies. I really like this breakout after consolidating for a bit. Usually off of a move to the downside, when you see something like this, you have a downtrend, sideways consolidation, you expect it to break to the downside, but that's the short-term chart. The longer-term chart on Disney does not show, in my opinion, a downtrend. It actually shows an uptrend with just a longer period of consolidation. I think in the short term, this is very bullish to have broken out. Would it be more bullish if we had more volume? Absolutely. That's the one downside I would say here, is that the volume hasn't been that great, but we are getting a bullish crossover, golden crossover, the 20 over the 50, price breaking out above the 102.75 area I think is bullish. Watch the rising 20-day. As long as we stay above it, I would be a buy. I would have a buy on Disney.
All right. And again, I know we've talked about this, but it's been really popular in the chat room, and that would be IWM. Like I said, we've talked Russell 2000. Some of the things they're looking at are a bearish engulfing candlestick 2 days ago, a hanging man candlestick, a MACD divergence. So, I mean, what are your thoughts?
I'm bullish. I own the IWM. I've been talking about small caps for a while, so I'm going to stick to what I think works. This is an index that does very well during periods of the rising dollar. I think the dollar is just starting to move higher, so I think that the relative performance here is going to continue to be very strong. I'm going to go out. Let's just go a year on this chart and quickly give you an update on. I see an ascending triangle. So you got a beautiful move to the upside. We've had rising lows and equal highs. So here is, I'll get it up here. There we go. There are basically your equal highs coming across. High one, so in a triangle, you have A, B, C, D, E. And this is now a breakout potentially. And we're also breaking out to an all-time high. So this is no small minor breakout. I expect as long as we hold that rising 20-day moving average, I would want to be long the small cap stocks. And personally, everybody's got to make their own call, but I am overweight the small caps. I think the IWM continues to outperform over the summer and perhaps throughout 2018. So I'm sticking with it. But today, a breakout above the 160 level would be much better short term than a move below. As far as the bearish engulfing or hanging man or whatever, those are very short term signals. And after we got the bearish engulfing, we did go down 1 day before breaking out. So I think it's played out. I think we got a really good breakout on our hands here.
All right. Yeah, it's good to see the small caps so healthy. All right. The only financial sector request, and that's very unusual. We usually get pretty much overweight tech technology and financials. Berkshire Hathaway is the only financial that was requested today.
All right, we'll do the B.
Yeah, BRK/B. That's the one they were.
The only one I can afford. No sense in looking at the A.
Yeah.
Yeah, I mean, again, the problem with Berkshire is the same problem with the S&P 500. And if you look at the S&P 500 chart, you're going to see almost a mirror image of what we got going on with Berkshire Hathaway. The problem is it owns a lot of companies that are multinational companies. And so in a rising dollar environment, these are going to be shunned to some extent. I'm bullish Berkshire Hathaway. I'm bullish the overall market. I just think this is an area of the market that's going to underperform on a relative basis. So I would be watching a couple areas to the downside, major support around 191, and to the upside, it would be bullish if we get through 203.
All right. One that was kind of interesting, we had a few consumer staples come up, but Colgate-Palmolive, while it's in the lagging category, has turned more into that northeast direction. So I thought that would be interesting to look at.
Yeah, it's probably not a very good wind blowing right now. Yeah, and I don't know. I haven't even seen the RRG, but I'm guessing it's turning in the northeast from that left side of the RRG.
Mm-hmm.
Tells me that it is not a healthy stock. So I don't like it. I don't like this space. The market is shunning these consumer staple stocks, and so I think you should too. To the downside, I mean, I can't even really make an argument for momentum at this point because as we've been selling off, we've been doing so on very heavy volume. Yes, we're oversold. So look for a bounce maybe to the 20-day at some point. But again, I don't know when that bounce is going to occur. I'm not going to try and catch it. I'm not going to try and catch that falling knife. So I would pass on it. But yeah, again, turning northeast from the left side to me is different than turning northeast from the right side on those RRGs.
Mm-hmm. I think Julius has talked about that. Something to ask him about tomorrow, maybe.
Mm-hmm.
All right. Let's see. This one I used to play a lot, but I got burned so many times. The Natural Gas Fund, UNG. Energy's doing pretty good. So what do you think about UNG?
Yeah, energy's doing well. Natural gas, not so much. I agree with you. This is one that's burned me in the past. I stopped trading this thing years ago.
Me too.
I couldn't figure it out. I don't know if it's because technical analysis just doesn't seem to work as well with it or what, but I gave up a long time ago. But having said all that, I'll give you my technical analysis of it.
Yes, there you go.
You might want to do opposite.
Yeah, exactly.
UNG's been trading sideways here between 2160 and 2340 for the last few months. It just banged its head up against resistance yesterday, pulled back. A breakout above 2340, you would expect to see some continuing movement to the upside, but I'm not seeing anything here. And with the small caps going the way they're going and some of the other areas I think that look very compelling, like financials, the banks, life insurance companies, this is just not for me, so I'm going to pass.
All right, sounds good. Under Armour, UAA.
Yeah, this one has really begun to improve. So I like the recent gap up. I think it was with earnings. Actually, it might have been this gap up back in February. Came back into this gap support zone, but is since broken out. And you can see the volume starting to come in. I think the stock's being accumulated. It's been a stepchild of the market for a long time, but I do think that it has improved and is now a much, much better, much more healthy looking stock. And so given the strength in the PPO, I would be watching to the downside the rising 20-day moving average. As long as that holds, I like the stock. I think it goes higher.
All right. Let's see. Next one from the materials sector, Freeport-McMoRan, FCX.
Yeah, I mentioned this one in the at the top of the show. It is helping to lead the non-ferrous metals group higher, along with materials in general. But I think it's up against some pretty key resistance. Now, can we get through? Volume is starting to pick up a little bit. I think the current price, maybe up to that 50-day moving average, is something to watch. If we can get through, I think it's likely to make a run for 1840, which is the top of gap resistance on this huge volume down move. But it is holding at 15, has reversed back up. I don't think I would be jumping in at this point, but a move through the 50, I think you do have a shot maybe at 1840 or so.
All right. And to finish it off, we haven't looked at a biotech in a while. How about LGND?
Ligand. breakout, and volume's been expanding. Hard to not be a fan here, especially given that the overall industry is not doing so well. Got a nice breakout here. PPO looks good, and the volume that I was referring to down here is very solid relative to what we have seen previously. So I think you got a high volume breakout. It is overbought. RSI now at almost 75. So a pullback would be better for entry. 20-day would be absolutely awesome because it's sitting down here near gap support. I don't know if we'll go back down that far, but maybe even a move back down to about 180 as the 20-day rises would be a reasonable entry.
All right. And with that, that completes the 10 and 10 to 1. So here are your stocks for the 10 and 10. I will have these up after the show in the Market Watchers Live chart list with all those annotations. Just go to the blogs tab, find the Market Watchers Live blog, and you'll see the link to that Market Watchers Live chart list right at the top of that blog. With that, I think it is time for a market update and a little bit of a talk about ChartCon that's coming up. StockCharts.com/ChartCon. I'm not going to spend too much time, but most of you who've been watching regularly know, on August 10th and 11th, we will be having our biannual, I guess, every other year chart convention, ChartCon. You do not have to fly to Seattle or get a hotel room because it is an online streaming live conference. So very easy to attend. It's only $249. You're going to get to see all of these excellent speakers that you can look at here. The schedule is right here, the agenda, so you can see the different topics. And like I said, for $250, I think you'll make that up just watching probably one or two of these speakers. So I think it's an excellent investment for yourself, and I highly recommend you go check it out and join us virtually for ChartCon 2018. And let's go ahead and move into a market update. Let's see what has been going on right now. I'm going to change up these down here. I always like to add the TSX. Maybe I can convince the powers that be to just add that in there. And then let's go ahead and look at XLB. I know you had that one on earlier, so we'll get a two-day vision of the indexes, etc. So these are two-day charts, 10-minute, I think 5-minute charts. You can see what's been going on. We had that pullback, a double top earlier for the Dow and for the S&P, and we got the pullback that got it right down just below or near the close. And now we've taken back off, and now we're forming a flag on all of these major indexes. So I think that looks pretty good. Surprisingly, the TSX is not doing quite as well as the American markets are. Yesterday, it actually closed higher, looking better than the major indexes here. And we can see Treasury yields, as you were talking about, are moving up just slightly, currently above 3%, 3.085. We can see UUP, big gap up. Made a nice high earlier right before the show started, and then we can see it's pulled way back, but it is still up. UUP at 24.55. Commodities are moving higher slightly. We've now gotten into positive territory, spent most of the day in negative territory. USO is down slightly, reading at 14.38. GLD gold was down quite a bit, but we can see it's made a resurgence. It's still down, but only down 9 cents, reading at 122.39. The VIX is continuing lower, so we're seeing a little bit more complacency, a little less worry right now in the market, reading at 13.47. And finally, a look at materials. You were talking about it earlier, and we can see just taking off. Had a little bit of a flag going on here. Now we're up, forming another flagpole, possible flag. So materials looking pretty good today. And with that, I'm going to conclude our market update and move us on into sector rotation. And I know this is something we haven't looked at in quite some time. Let's see. I'm going to go ahead and switch it up to my favorite graphic here. Hopefully you can see it fairly well. We talk about sector rotation all the time. I love this chart. I'm actually going to have it rebuilt so it's a little bit more clear. It's great. It shows you the sectors, and as you're rotating, you know, what you should be expecting as far as the business cycle and, you know, where we want to be. So one of the things that has concerned me quite a bit over the pullback and during this correction was, of course, the resurgence of consumer staples, healthcare. But now we're starting to see that move back. You know, financials are starting to do a bit better, and especially now that we're talking about these Treasury yields, cyclicals you want to do, technology, all of these are the ones you want to be showing with the most strength. So that's what we look at sector rotation for, to sort of see where we are in the business cycle, but also, you know, in the stock market cycle in general. So this particular graphic, let's see here, I'm going to get back over here. There we go. This is also another graphic you'll find in Chart School. So again, I think it's a great way to look at the various cycles, market bottoms, tops, of course, the economic cycle. So this one you'll find in Chart School, and there's plenty of information about sector rotation there. But with that, I'm going to quickly move us back over into what I like to look at. And we're going to go right from, I'm going to take us from the sector summary. And we do this fairly often. And again, materials doing the best. That's one of the ones we looked at earlier. I think that actually could be a really interesting sector given the scooter and some of the movement going in the right direction there. But I want to look at what's been going on as far as rotation over the last 3 months. Where are the leaders? Obviously, energy has been the place to be, but we can see cyclicals and technology also doing well. Those are the sectors you want to see doing well. I think I'm going to go ahead and look in the energy sector. Actually, I looked at energy yesterday, so I'm going to go ahead and go into the cyclicals and see what we can find. And obviously, you know, it's great. You could click there. You're going to get all of the industries. So I'm going to just look at percent change over this time. Travel and tourism clearly doing the best. I'm going to pick something a little bit lower down the list because although I want to see that kind of strength, I want to still see some upside momentum. So I'm going to go into the specialty retailers, which I know have been doing fairly well. And then I'm going to go ahead and look at it, the scooter, and see what we're getting here. So these are the high scooters. This is the StockCharts technical rank. And so some of the ones that I was looking at, again, I'm not necessarily going to go with the top 3 or 4. I want to look at some that are maybe in the 80s, hopefully getting ready to move up higher. I'll pick Ulta. I kind of like that store. Now, I'm looking at this chart, and of course, the first thing I see is this overbought PMO sell signal. So while this is in a strong sector, while it does have a nice strong scooter, we can see the scooter has been moving lower. So I'm not thrilled with this chart. I'm just going to go back and let's look at something else. How about the container store, TCS? Really nice breakout. Now look at the difference here. We have a PMO that's moving up gently along with this nice rally. We now got this big breakout. Of course, we don't like to chase, especially on these smaller value stocks, in my opinion. So I would want to watch this because a pullback to that breakout point could offer some very interesting potential here. And I will look at the weekly chart just to give myself a little bit of conviction here. So I'm going to annotate it, and then I'm going to pass it back to you, Tom, because I know we're short on time. And I want to have time for us to have a decent wrap up. Look at that on the weekly chart. These 2 tops have now been busted. Like I said, this is a low price stock. So if I start to see a bit of a pullback on this one, I think it would be very, very interesting, as we like to say. But that's an important thing to look at, is a breakout like that on the weekly chart, I think is really encouraging. So with that, I'm going to pass it back to you, Tom, so that you can get a few of them in.
Okay. Actually, I just have one chart I want to show
Okay.
in terms of sector rotation. And one of the things that I follow in trying to determine whether or not I think a rally is sustainable or not. And I like to give credit where credit is due, and I got most of my ideas, especially on relative strength and looking at different markets and asset classes and so forth, from John Murphy, reading his book and following along in his market messages over the years and so forth. So, John has always been a mentor, really, of mine. I love his work. He was one of the first, if not the first, that really began talking about the movement of money under the surface of the market. So, of course, on CNBC, we're always hearing about what the Dow is doing, what the S&P 500 is doing, and so forth. But a lot of times we don't hear what really matters, which is where the money is rotating within the market. And one of the things I think is really important as we go forward is that we want to see money continue to rotate towards aggressive areas of the market. As long as traders are aggressive and as long as volatility is under control to the downside, meaning that, the environment is such that the market can handle bad news, then I want to make sure that I am still staying on the long side. So here we've got the technology group, the XLK relative to the S&P. So as this is throughout the entire bull market, so as the S&P 500 has been going higher, you can see that technology on a relative basis continues to push higher. Even this year, with the S&P going down and consolidating, you can see the XLK, and this was reflected, I think, too, in the 3-month chart that Erin was just showing on the different sectors and how they've performed over the last 3 months. Technology has been up 3%. That normally is not what you're going to see right at the start of a bear market. As you're starting to move down, folks tend to get out of those riskier assets, and we begin to see underperformance as we set our final highs to the upside. That is not what has happened here with technology. Industrials on this high in January also set a new high, although they have pulled back. Again, I've talked a lot about that. I think much of that has to do with the rapidly rising dollar. We've seen recently a pretty steep decline in some of the industrials. And I think, again, you're talking about a lot of these companies that do business, a lot of their business overseas. And as a result, those profits, those foreign profits are going to have to be translated back using higher dollars. And as a result, you're going to have some foreign currency translation losses. So the XLI, I'm fine with it pulling back some while the dollar's rising. In fact, I think the XLI is going to have a hard time breaking out as long as the dollar continues to move the way it is. But we moved down consumer discretionary, which has recently broken out to new highs, like the technology area, and financials. And I showed that chart earlier. I really believe that the financials, the XLF, I think this is a group that is going to perform very well throughout the summer and maybe throughout the balance of the year. I think I showed that negative correlation that's developed recently between the banks and the S&P 500. When you consider that relationship versus the 10-year Treasury yield, we've seen the yield moving up. Normally, the relationship of the banks relative to the S&P moves up as well, and that has not been taking place. I think we're about to see that change. I think that the banks are a great area to consider, especially on a reward to risk basis. And so I look for this to turn back up. But again, there's no hints really as far as when I look at these 4 major sectors and compare it to the S&P 500, I don't see any major warning signs. In fact, I see just the opposite. I see a market that says it wants to go higher. So I'm still expecting the market to break out based on the sector strength, the key aggressive areas of the market. I think it's helping now that energy is also breaking out. As Dan Russo mentioned earlier in the show, commodities, if you take out gold, commodities are doing pretty well relative to the S&P 500. I could even pull that chart up, which is the CRB relative to the S&P 500. And let's just do a 1 year and use a line chart, get rid of all that noise from the candlesticks. But you can see that on a relative basis, we had been kind of sideways consolidating for several months, meaning that the CRB was just kind of going along for the ride with the S&P. But over the course of the last couple of months, we're starting to see some of those that relationship change. We're actually seeing commodities outperform on a relative basis, which this is a group that has not really performed and hasn't been as much of a part of this bull market. So I find it somewhat encouraging that we see the CRB moving up. And of course, some of this relates to energy and the strong performance recently by energy stocks. So if you wanted to see, for instance, the S&P or the XLE relative to the S&P, Erin was talking about over the last 3 months, the strong performance in energy. This is another way to look at it. Huge relative strength to the upside. And this follows what has been a pretty bullish move on or in crude oil prices. If we pull up crude oil prices and take a look, the crude oil prices had broken out back, new highs back in April. And in early March, you can see we were actually back up at, trying to negotiate the January highs. And yet late March, you can see energy was just starting to make a move. The XLE was just starting to make a move. So this does not surprise me that the XLE continues to rally versus the S&P, given what we've seen in crude oil prices. And that's essentially what I had for the sector rotation, some of the things that are taking place. I could talk a lot more about the rising dollar, but I think we covered that earlier in the show.
Absolutely. You know what chart I'd like to show, though, really quickly before we leave is GE. I mean, it's been on everybody's mind. We've been talking about it a lot, so I wanted to give my 2 cents. One of the things I wanted to point out is that right now I just got a 20-50-day EMA positive crossover. That should go into effect, which means I'll get an intermediate term trend model buy signal. And if you look here, we have not seen the 20-day EMA above the 50-day EMA for over a year. So I think that's a pretty outstanding signal right there. Yeah, the PMO is a little bit on the overbought side, but not really when you consider the range it normally travels in, which I believe is -2 to +2. So, if you look in the thumbnail, OBV is actually starting to show some interesting information. And also the scooter is now reaching a level we haven't seen since, well, let's go back, since June of last year. So I think a lot of things technically are changing for GE. To the positive.
That's pretty amazing when you look at a stock that has a scooter of 14 and you're talking about how strong it is, right? The fact that it's only a 14, but it is definitely strengthening. I think that scooter is starting to reflect that. Okay, well, let's go ahead and summarize that sector rotation that we just talked about. And then Erin can go through the upcoming schedule, and then we'll get things wrapped up here. But there you can see Erin's rotation and some of the things that she talked about, a couple of the stock symbols that she talked about. And I just simply looked at the sectors relative to the S&P and talked about a couple other ratios.
Yep, looks good. I guess let's hit the schedule and then wrap this thing up. So tomorrow we have Julius de Kempenaar, the Mr. RRG, and he will be here to talk RRG. Obviously, everything stock charts will be on Friday, and then you get to have Julius back next Monday and Tuesday while I'm out. And finally, David Keller is going to return with us on Wednesday of next week.
Awesome. We're going to be getting a lot of Julius, and I know a lot of fans out there like to hear what's going on with the RRG, so we certainly look forward to that. I want to thank everybody for being with us today. Please remember to complete the survey as you exit, and especially today. I'd like to see what you thought of the discussion that Dan Russo had. Also, we spent a lot of time talking about rates and the direction of the rates and the dollar and the impacts. Love to hear your thoughts on what you thought of that whole presentation and some of that discussion. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We hope to see you back here tomorrow on Thursday. Happy trading.
This is a little info demo to show you how to put a solid line or something like that on the top of an indicator that you might already have. When you scroll down here, it was on the SCTR line, but I want an overlay of a horizontal line. And in this case, I can set it up so I put the line at 75.4 on the indicator SCTR, and using the colon symbol and then the word blue, it'll put a blue line up there for me like this. So if you're looking to do overlays, just those simple little tools, but use the colon command to help color it.